So this just happened. The Fed cut rates by a quarter point this week on September 17th. The new range is 4 to 4.25%. They said it would help families. Instead, average 30-year mortgages jumped about a quarter point right after. And here are the key takeaways that you want to remember. First, markets already expected the cut, so the good news was priced in. Next, the bond market, not the Fed, sets long-term mortgage rates. Also, the 10-year Treasury ticked up and mortgages followed it higher. And finally, a similar thing happened last year. The Fed cut, but mortgages still climbed. To make this simple, it's like this. You hear a store will run a sale next week, and everyone hears about it, so the store raises prices the day it starts. So your deal costs more the moment that the sign goes up. And here's what this releases. Short-term loans may ease a little, like HELOCs and some adjustables, but long-term fixed mortgages may stay sticky or jump on scary headlines. If you're buying, you lock when rumors start, not after a press conference. If you're selling, plan for buyers who need help with payments. And here's why it matters. Home buyers pay more per month the day after a helpful cut. Cash buyers gain leverage when financing gets shakier. And landlords see steady demand because renters stay put longer. If the job market keeps softening, wallets tighten across the board. And when it comes to the quiet part no one is saying out loud, the Fed blinked because the labor market looks weaker. When they say it's risk management, when you hear that phrase, they mean they're nervous about what's next. They don't control 30-year mortgages. The bond crowd does. The signal wasn't comfort, it was caution. But here's what the experts are saying. One camp says cuts can help later once inflation cools and bonds relax. Another says don't count on quick relief. Mortgage rates move on expectations. Then the third warns too many cuts could reheat inflation and push long-term rates higher. And they all agree on one thing though. Mortgage rates don't move in lockstep with the Fed. And here's what most people are missing. The pattern runs on the 10-year yield and new data, not speeches. Jobs, inflation, and deficits hit the screen, and mortgages move first. By the time you hear the headline, lenders already changed their term sheets. But as always, there are two sides to the story. Side A says the cut cushions the economy and will help households over time. Side B says the cut confirms trouble and keeps long rates higher for longer. And here's what the smartest person in the room is thinking. The Fed can cut short-term rates, but long-term money is now set by the bond market, the pension funds, foreign central banks, and hedge funds. This feels like the old stop-go era of the 1970s and early 80s. Back then, the Fed would raise rates to fight inflation, then cut as soon as jobs weakened. Then markets, they would push back, and inflation never really died, and rates swung up and down for years. That's the rhyme of today. The Fed eases, but investors may keep long-term rates high anyway. But here's what everyone wants to know right now. Why did my rate go up after a cut? Because the 10-year yield went up. And then should I wait to buy? Well, only if the payment at today's rate breaks your budget. When will rates actually fall? Well, we don't know yet. We're watching jobs and we're watching inflation. Will more cuts fix it? Maybe for short-term loans. Long-term loans answer to bonds. Can I still lower my rate somehow? The answer is yes. Ask for cash up front from the seller to lower the rate for you. That's what we call a rate buy down. Yet, here's what we really need to know before we know what comes next. If the next inflation report cools, do long yields drop or do they hold? Does the job report confirm weakness or does it bounce? Will the Treasury issue more long-term debt and push yields up again? What's your real payment limit if rates pop another half point? The one question the top operators ask is this: who will give me better terms today than the bank's plain 30-year? Well, check out ridgelendinggroup.com. They've got DSCR loans, debt service coverage ratio loans, that are better than the bank 30 years. That doesn't happen very often. But has all of this happened before? Well, the answer is yes, pretty recently, and here's how it ended. In the late 2024, the Fed cut rates 3 times, yet mortgages rose toward almost 7%. So if history repeats itself, the takeaway for the next 2 to 3 years, you want to plan for bumpy rates with short relief windows. And when you see a dip, move fast to lock it in or refinance. So the quick translation for landlords: the Fed trimmed short-term rates, but long-term mortgages got pricier because big bond investors see risk. Expect renters to stay longer and underwrite your new deals at today's payment, not some dream rate in the future. And if you need flexibility, consider an adjustable or a shorter fixed period that you can refinance later. If you're buying or selling, you want to use tools that shift payments, like cash up front to lower the rate for you. That's a rate buy down. Or take over the seller's loan at their old rate. That's an assumable loan. Or buy the house and keep the seller's loan in place. That's what we call subject to. Or a new loan that sits on top of the old loan. That's a wrap. And use simple words with sellers. Ask if they'll take a down payment and the rest over time. Technical jargon tends to either confuse them or scare them away. And in both of those scenarios, you end up with no deal. So for more videos, community support, and the Deeper Dive newsletter, links are below in the description. And in case you missed the last one, this here is going to get you all caught up. Thanks for watching. Have a blessed day. Take care.